Hi, good afternoon, everyone. My name is LSpeidel, and I am Assistant Vice President, Regional Manager for Exeter 1031 Exchange Services. Today, you're joining me for a webcast about the 1031 exchange, learning the fundamentals, advantages, and approaches for utilizing a 1031 exchange to accumulate wealth. First, I just wanted to I'll let you know that in the corner of your screen, the top right-hand corner, you will find a question box. So if there are any questions, please feel free to type them in there and send them over to me. There's also a material button, and if you click on that button, you will see a PDF version of my guidebook. The guidebook in physical form looks like this. It is probably one of our most requested marketing pieces. This version that I have in the corner, it says 2024. If you take your phone and take the camera and hover over this QR code, there should be a website that pops up towards the bottom of that image. And that'll also take you to the virtual version of this guidebook. In the corner, it will say 2023. But it's exactly the same guidebook. So this is just the new printed version, but the same one that I have in my hand is the same one that you'll have if you look through that QR code or pull up the PDF in that material button. So today we'll be discussing forward exchanges, the history of exchanges, why someone would do an exchange, as well as the requirements to successfully complete an exchange, what really matters in a 1031, and then also our role as a qualified intermediary. So I'll just go from there. So a 1031 exchange is an IRS code that allows you to take property that you had the intent to hold for investment purposes, so rental income, appreciation, or use in a trade or a business, sell that asset, defer the tax liability associated with the sale, and have all of your proceeds working for you in another piece of real estate, again, with the intent to hold for investment purposes. So rental income, appreciation, or use in a trade or a business. Section 1031 was created actually in 1921. It was called Section 202C, and it was really specific to allow you to exchange securities and any kind of property. So it was to encourage investment and economic growth. In 1924, the IRS eliminated the ability to exchange non-like-kind property. At that time, if you had personal property, you'd have to exchange it for other personal property. If you had real estate, you had to exchange it for other real estate. So this Section 1031 became more and more specific as time went on. The section number at that time changed to Section 112B1 with the passage of the Revenue Act of 1924. And then in 1935, the Board of Appeals approved the first tax-deferred like-kind exchange using a qualified intermediary. And that is what we are. And I'll explain exactly what we do in just a few slides and how we are vital to a 1031 exchange. But it also upheld the cash in lieu of as to not invalidate the 1031 exchange. One of the requirements when you're doing a 1031 is that you don't take constructive receipt of the proceeds. And so that's also a step that we take care of when doing a 1031 exchange. In 1954, the Revenue Act of 1954 amended the Section 112B1 to Section 1031, which is what we now know of it today. And for the most part, at this time, you would see people really sell and buy within minutes of one another. Having a concurrent closing was very common. And prior to it actually being a code in 1921, you would see farmers barter for livestock, they'd barter for land. So this give and take relationship was very common. In the 1970s, there was a specific case And some people who've been in the industry for a long time will know the last name Starker. You'll also hear 1031 exchanges be called Starker exchanges. And that's really because there was a specific taxpayer, TJ Starker, who was a timberland owner. And he sold his timberland to a paper mill company called Crown Zellerbach. And over 5 years, he finished his exchange. So he basically traded in units for property. And when he was done, he filed his exchange. He was audited by the IRS. He paid the tax, but took the IRS to court for 4 years and eventually won. So this is really where we started seeing a pretty significant change with 1031s and it becoming more stricter. It basically allowed a period of time between the sale and the purchase. Again, prior to that, we really saw these transactions happen within minutes or hours of one another. You'd sell and buy all at the same closing table on the same day. That Starker case really changed the 1031 industry forever. It really demonstrated that you could not have to, you could do a delayed exchange. It wasn't simultaneous. So that really opened up opportunities for people that were interested in doing a 1031. And then in 1984, the IRS clarified the delayed exchange timelines, and they basically stated that you had 45 days to identify possible replacements, and then you had another 135 calendar days to close. So a total of 180 calendar days. With that, in 1991, the IRS issued regulations outlining safe harbors for qualified intermediaries to ensure compliance with the 1031 exchange. So prior to that, you would see attorneys actually act as a qualified intermediary. Now, the Section 1031 states that anyone that has provided tax or legal advice in the past 24 months is disqualified from being a qualified intermediary. So if for some reason your accountant or your attorney wants to act as your qualified intermediary, that could disqualify your exchange. And as a qualified intermediary, we're unable to provide tax or legal advice. So they were very specific with what doesn't qualify. In 1997, the IRS also amended the Taxpayer Relief Act of 1997. They clarified even further that when you're doing a 1031 exchange, domestic property is like kind to domestic property, and foreign property is like kind to other foreign property. So if you're selling in the US, you can't buy in Mexico, per se. Revenue Procedure 2000-37 provided guidance on structuring reverse 1031 exchanges. I would say over 90% of our transactions are forward exchanges, but there definitely is an interest in reverse exchanges, and I'll explain what that is a little bit later. And then in 2017, so the most recent change to Section 1031 is that personal property exchanges were eliminated with the Tax Reform Act of 2017. So you would see at that point, let's say Enterprise, for example, do 1031 exchanges with fleets of cars, or UPS with a plane. With a personal property exchange, it was very specific. If you used personal property a certain way, that is exactly the type and kind of personal property you had to purchase. But that now no longer exists. The only type of 1031 exchange that does exist is real property exchanges. And that really took up over 99% of our business. It was not very common to see personal property exchanges, even though we did assist with them as a qualified intermediary. So the big question, of course, is why would I participate in a 1031 exchange? Most people that are owning investment property don't really realize the tax liability that might come with the sale of their investment property. When you have an investment property, you often depreciate it, you possibly make improvements to it, but when you sell it, there's going to be a gain. There's no tax code that defers that gain like your primary residence. When you own a primary residence, there is a code called Section 121, and as long as you've lived in the property 24 out of the past 60 months, and you haven't used the exclusion in the past 2 years, you would qualify to exclude $250,000 of gain if you're single, $500,000 if you're married. So that's the benefit of owning a primary residence. But with a 1031 exchange, you don't have a code that does that. With a 1031, there are specific guidelines, but you can defer your tax liability if you follow the rules and the regulations of Section 1031, and it keeps more money working for you and helps you to accumulate wealth by deferring that tax liability. On average, I would say most people are somewhere around 25 to 30% in tax liability when you look at the overall gain. Oftentimes, people will also call and not really have a true understanding of how tax liability is calculated. Sometimes they think, well, I bought it for this much and I'm selling it for this much, and that's the difference. And that's not necessarily the case. To calculate your tax liability, and we'll give some examples here. Let's say, for example, you purchase a property in just a regular purchase. The original purchase price is what we call your cost basis, but this number fluctuates. It doesn't stay the same number. Your adjusted cost basis is extremely important when factoring your tax liability. You take your original cost basis, you subtract the depreciation that you've taken over the lifetime of owning the property, and then you add back in any capital improvements you've made. Depreciation is important. I definitely recommend people to take it. If you do not use depreciation on your tax return and you sell an investment property, you'll still be required to pay 25% of that depreciation that you should have taken back. So it is a great tax benefit to use depreciation, and it's usually recommended to do so. And then capital improvements are different than repairs. That's something I do like to point out. Repairs bring something back to its original condition. So let's say that you were fixing a leaky faucet. That's going to be a repair. That's not going to have any adjustment to your cost basis. But if you were doing new hardscape, gutting a kitchen, gutting a bathroom, putting all new flooring, all new roofing, all new siding, those things elongate the life of a property. And so those capital improvements you add back into your basis. Also keep in mind that with a commercial property, normally your property is depreciated over 39 years. So your accountant would give land value to your property and then take the rest of it. This is straight line depreciation. And divided over 39 years, that would be the amount of depreciation you could take. If it's a residential property, it's 27.5 years. But having an accountant to keep track of all this is definitely important. They'll definitely be an integral part of your 1031 exchange. So when factoring total gain, you're basically taking your net sales price, which is the gross sales price, minus routine closing costs, broker's commission, closing agent fees, qualified intermediary fees, and you're comparing it to that adjusted cost basis number. And that's what's going to equal your total gain. So I'm going to give you a quick example so that we have real numbers to work with. Let's say, for example, you purchased a property and you bought it for $250,000. That was your original purchase price. It wasn't from a prior exchange. You just bought it outright. Let's say that you've owned it for let's say it's a residential property. You've owned it for well over 27.5 years. And so you have really depreciated the property down to land value. Your accountant believes the land value is $30,000. Land does not depreciate, so that's as far as it's going to go with depreciation. And let's say you sell it for $530,000. When you sell it, you of course are going to have some expenses from the sale. For sake of discussion, let's say there's $30,000 of routine closing costs. So your net sales price is going to be $500,000. Now, if you compare that to your current cost basis, you've got a gain there of $470,000. So it's not the 250 versus the 500. Even if you had debt on the property, this does not come into overall tax numbers here. So let's say you do have a gain of 470. Let's say you took $220,000 of depreciation. You owe about $55,000 back to the IRS at a 25% rate. And then let's say you have $250,000 of gain, actual gain of value on the property. You've owned it for well over a year, so you're going to fall into the capital gains tax bracket, which is usually 15 to 20%. In this scenario, we're using a 20%, so that's about $50,000 going back to the IRS. And then I use 5% as an average state tax. There are some states that don't have state tax. There are some states that have extremely high tax. There's some that will change based on your adjusted gross income numbers. And then there's also some states that have a flat rate. Average in the United States is 5%. So that's the number I'm using here. And oftentimes the state wants some of that depreciation back as well. So they go off of that full gain amount of $470,000. So you've got about $23,500 in state taxes. And then you might have the AMT tax, also called the Medicare tax, Obamacare tax. If your income is above $250,000 if you're married, some of this gain might increase your adjusted gross income numbers. So anything above that amount will trigger 3.8% in additional tax. So that's something that you'd want to talk to your tax advisor about. So overall, let's say you were to sell and not do an exchange, you're looking at over $128,000 in taxes to the IRS with around $370,000 to reinvest. If you do a 1031 exchange, you are deferring the tax liability, and then you have the full $500,000 to reinvest. So as you can see, you're able to build your wealth through real estate much quicker because now you have more cash working for you as a down payment on maybe a larger property or a property located in a different area, a different sector. And so this can become very beneficial for people. Now keep in mind, the 1031 exchange is not a tax-free strategy. It's not like your taxes go away. It's a deferral. So the tax that you deferred on the property we were just talking about, let's say, that $470,000 of tax, that gain rolls over to your new property. So if you were to buy a property, let's say for $500,000, your basis is not $500,000. Your basis would still be $30,000 in this scenario because that $470,000 is just deferred. So it just reduces your basis. Now, the biggest benefit of the 1031 exchange is really to exchange throughout your life. Keep the wealth in your family. Ultimately, when you pass away, this is usually the biggest benefit, and it's a term that we use in our industry, which is kind of morbid. It's called the swap till you drop method. And that is basically you're swapping usually for more property or larger property or better property. And then eventually when you pass away, your tax liability goes with you when you pass. So your beneficiaries will receive a step up in cost basis. So let's say that same property 20 years from now is now worth $1 million. You pass away, your beneficiaries contact their accountant and say, how do I come up with a date of death value? The CPA will usually give a recommendation. And if it's worth $1 million and they sell it for $1 million, there's no tax liability. So it's a huge estate planning tool. We really talk about generational wealth a lot. This is one way to do that. Definitely recommend contacting an estate planning attorney to make sure that you're holding the asset in a way where your beneficiaries, can bypass probate. They don't have to worry about who gets the property and who gets that step up in basis. That's definitely something you want to discuss with your estate planning attorney when you're talking about investments and assets like real estate. Now, in order to successfully complete an exchange, there are a number of rules that must be followed. Some of these are going to be really simple rules, but they're all important. And this one is a pretty simple rule. You must have a relinquished property. So you must have a property that you want to sell. In our world, you'll hear that be called the relinquished property. And then you also will want to be purchasing a replacement property. You don't have to have the replacement property ready to go lined up when you're selling your relinquished property. You do have some time to do that. But the point is that you've got to be selling real estate, you've got to be buying real estate, and you can sell more than one and you can buy more than one. So as long as they are qualifying properties, then you can involve them in an exchange. Now, after you talk to your tax advisor about your tax liability, so your CPA or accountant, and after you have a contract for your sale, sometimes even before you have a contract, you'll want to reach out to a qualified intermediary, and that's what we are. You'll also hear us be called a QI or 1031 exchange accommodator. We must be assigned into your sale before closing and also your purchase before closing. So if you were closing today and you called us tomorrow, you would no longer be able to do the 1031 exchange. The settlement statement will have to show that a qualified intermediary is assigned into the transaction. So we're acting as an agent on behalf of you. With a qualified intermediary, we're going to draft the necessary 1031 exchange documents for the sale and the purchase. We are going to hold the proceeds so that the exchanger does not have constructive receipt of those proceeds. And then we're also going to help advise and help structure. If we see risk or we're talking to you and you bring up something that might cause risk to the transaction, that's a discussion we're going to have with our clients. Everyone's risk tolerance is different. So what someone might feel comfortable with might be very different than what I might feel comfortable with if I was doing an exchange. But ultimately, if you do have an accountant, you have an attorney that would like to discuss the transaction, we do try to be very consultative and advisory and available to you and your agents should those questions arise. Now, in order to qualify for a 1031 exchange, you've got to have the intent to hold both the relinquished and replacement property for investment purposes. So that's usually going to fall into rental income, being held for appreciation, or for something used in a trade or a business, which is usually commercial space. Property held for sale will typically not qualify. So we're talking about fix and flippers, for example. If you're a fix and flipper and you buy a replacement property with the intent to make improvements or repairs and then sell it, you don't have the intent to hold the property. And so under audit, your transaction would most likely be disqualified. Same thing with developers. So property that's acquired specifically to develop, if you don't have the intent to hold it for investment purposes, it usually will not qualify. Keep in mind that intent can change. So if you are a fix and flipper and you buy a property and your intent was to sell it, but then you realize the market isn't doing so great, you could get a renter in there, have that renter lease from you for, let's say, 12, 24 months. You report that rent on your tax return. Now you can easily prove that you did have the intent to hold for investment purposes, because that's exactly what you did. And in that scenario, you would have been holding for rental income. So keep in mind that intent can change. There's also no specific or required holding period for a 1031 exchange. Most advisors will recommend 12 to 24 months because that property is usually going to be reported on your tax return for 12 to 24, or for 2 to 3 tax years, excuse me. That way, if you were audited, you could easily prove that you had the intent to hold, because that's exactly what you did. So again, no specific requirements. I had a client once who bought a property. They started to make updates to it and things just kept going wrong, and basically had used all of their savings and had said, I'm done. I just want a turnkey property. He had emails to his realtor, receipts, really showing that his intent was to hold the property for investment. He had emails to his realtor on what kind of property he wanted. He did want to update it and then rent it. But again, everything just kind of fell apart. So he did decide to do an exchange, and he bought a property that was turnkey. And in that scenario, he had material to back himself in case there was an audit. Now, the like-kind requirement is a very simple requirement. People do often get this confused with the personal property exchanges that were eliminated in 2017. with your like-kind requirement, it basically means any type of real property is like-kind to any other type of real property, as long as the intent to hold requirement is met. So you could be selling a single family property and be buying any of these like-kind properties. So multifamily, office, retail, industrial, vacant land. You'll also get into some lesser known properties. Oil and gas interests are considered a real property, mineral interests, air and water rights. And then there's also fractional ownership. With a fractional ownership, this can be great for someone who maybe doesn't want to actively manage a property. There are companies out there that create syndicated TICs, tenant in common structures, Delaware statutory trusts, or 721 UPREITs. And what these are these real estate companies go out, they buy a couple of properties or a property, they package under one of these kind of titles, and then they usually sell the equity to investors. With a tenant in common structure, the max amount of investors are 35. Everyone has voting rights. Usually if there's a loan that is attached to that portfolio, everyone's being underwritten. So it was very common up until about 2008 through 2010. Those were the most common type of fractional ownership portfolios that we saw. But as we know, the real estate market took a crash then. And so there were opportunities where a real estate sponsor would say, we think we should sell, and here are the reasons why. And if there was one investor that didn't want to sell, then everyone would be stuck holding the investment. So you started seeing the industry shift more towards the Delaware statutory trust structure. It's very similar to the syndicated tenant in common structure, but you can have almost 2,000 investors. You're not being underwritten for the debt. It's non-recourse to you. It's normally larger amounts of equity that they're selling. And you don't have voting rights. So really that real estate sponsor is determining when it's the right time to sell. So they're taking a look at, definitely different scenarios and situations and deciding what's best for everyone. And then the more very common thing that we're seeing these days are these, it's called a Delaware Statutory Trust 721 UPREIT. And they're structured as a Delaware statutory trust, but eventually after a certain amount of time, typically 2 years, they have the option for a real estate investment trust to buy the beneficial interest of that Delaware statutory trust. So they're absorbing that real estate. And in turn, those investors are usually receiving UPREIT shares, and then they can liquidate those at certain times throughout the year. Sometimes there's a holding period. But keep in mind, you're converting real property to shares. And so in this scenario, while it does provide liquidity, it does not qualify you to do another 1031 exchange, because now you own personal property, which are shares. So those three you would usually buy through a financial advisor or a DST broker. If that's something you'd like to discuss further, you can certainly reach out to me and we can discuss that. Non-like-kind property, so personal use assets, your primary residence usually doesn't qualify. Second homes and vacation homes can, but they must fulfill some specific requirements. So proper planning is key. Again, property held for sale, so conversion, development, fix and flips. Securities, cash, stocks, bonds, mutual funds, REITs. It's not real estate, so it doesn't qualify. Equity interests. So a lot of people get confused when I mention this. An LLC or a corporation can definitely do a 1031 exchange. But what you can't do is sell partnership or membership interest and do an exchange, or buy partnership or membership interest and do an exchange. And that's because you're selling or buying personal property. You're not selling or buying real estate. So if you're in a scenario like that, we of course could talk about your specific scenario. That can go in a lot of different directions. So vacation property and second homes. In 2008, the IRS came out with some safe harbor guidelines for exchangers. And what they said was that if you fit nicely into this box and you do a 1031, you're not going to have any issues with your exchange. And so they basically said that the property that you're selling, if it was vacation or second home, it must be held for 24 months as investment. So that means the last 2 years, you must have rented that property out for at least 14 days each year, the last 2 years. On the purchase side, it would be the first 2 years, and you would rent it out for 14 days at fair market value rent for the first 2 years. You report that rent on your tax return to prove to the IRS it's investment. And then you also want to limit your personal use. So on the sales side, you want to limit it to 14 days or 10% of days rented in the last 2 years. And on the purchase side, it's going to be the first 2 years. So that is definitely a question we have. When it triggers that question is when someone says that they have had personal use, they've been using it. If you use it all winter, for example, that would not qualify for an exchange. That's just going to be viewed as a second home, and it's going to have tax liability. So if you or you know someone that has a vacation property or second home, proper planning is key. Now, the reinvestment requirement is probably the most misunderstood requirement of the 1031 exchange. To have a fully tax-deferred exchange, you will want to trade equal or up in fair market value based on the net sales price. So that means reinvesting all of your cash from the sale and reinvesting the debt amount. So I'm going to give you an example so that it can be clearly seen here. Let's say you sell a property for $530,000. We're using the same example as earlier in the presentation. And you have $30,000 of permissible selling expenses. Your gross sales price then, or your net sales price is $500,000. Let's say you have a mortgage on it of $250,000. That mortgage is most likely going to be required to be paid off at closing. It probably has a due on sale clause. So that $250,000 mortgage is paid off, and then the other $250,000 will come to us where we will hold it for you. Your goal is to reinvest all of the $250,000 that we're holding and buy for $500,000 or more to have a fully tax deferred exchange. So you're not only reinvesting all of your cash, but you're also reinvesting that debt amount. You can reinvest that debt with another mortgage. You can reinvest it with out-of-pocket cash or a combination of both. So either one would work. There are definitely people who do partial 1031s. A partial 1031 exchange may not harm your overall transaction, but adjusted cost basis will be something that we'll ask. What is your adjusted cost basis? We want to make sure that you're reinvesting above that so that you're still getting a benefit from the exchange. If you pull any cash out or you trade down in value, that will result in something called boot. If you've read any online websites about exchanges, you'll hear that term, and that's because many years ago when you had extra cash, they'd place it in their boot. So cash boot is if you don't reinvest all of your cash. Let's say you take some cash out at closing, or we end up sending you money back because you haven't reinvested all of the cash that we were holding. That would be cash boot, and that would have tax liability. Mortgage boot is if you didn't replace the full mortgage amount. So let's say same scenario as the last one, instead of having a $500,000 purchase, you ended up buying for $450,000. You reinvested all your cash, but the mortgage that you took out was only $200,000. So there's $50,000 of mortgage that wasn't reinvested. You would pay tax on that. So whenever you're doing a 1031, we always recommend that you consult with your tax advisor, but especially if you're doing a partial. You really want to know what that tax liability may be. In some situations, it may not trigger tax liability. You could have something to offset the gain. That's not something we would know. That's definitely something your accountant or CPA would know. And then just be mindful that the IRS wants their tax. So the idea of taking cash out because you put some money down originally to buy the property, the IRS doesn't view the cash that you're taking out at the sale as equity until all of your gain is taxed. And then you can get to your equity and not pay tax on that. So it's the investment concept of first dollar in is your last dollar out. Now, the guidebook that I mentioned that we have, you can, again, just to remind you, on the top right-hand corner, there is a button called the materials or material button. If you click on that, you will get our guidebook. This list is on page 19 of the guidebook. Also at the end of the presentation, my QR code will come up again where you can snapshot that and it'll take you to the online version of this. But this is just an example of what are permissible and non-permissible selling expenses. So most routine closing costs are going to fall under permissible selling expenses. Permissible selling expenses will just reduce what you have to reinvest for a fully tax deferred exchange. So that's that gross sales price going down to your net sales price. So owner's title insurance premiums, closing agent fees, real estate broker commission, qualified intermediary fees. If you have CPA or attorney fees directly related to the transaction, you can give that to your closing agent to pay those expenses. Transfer taxes, wiring fees, all of those are considered permissible. Sometimes we do come across non-permissible selling expenses, and if you use your proceeds to pay for non-permissible selling expenses, you'll have tax liability on those amounts. I would say over 95% of our clients just have the closing agent use the proceeds from the sale, and in that scenario, they might have a little bit of tax liability. Some common ones we see are financing or lender costs, prorated property taxes, HOA fees, prorated rents, security deposits, paying down credit card balances or paying for repairs or maintenance costs. Those are all non-permissible expenses. So if you use your proceeds to pay for a non-permissible expense, it's gone, you don't need to replace it, but it will possibly carry tax liability. So again, page 19 of the guidebook will have these expenses. You could always discuss with me your final settlement statement or estimated settlement statement if you're concerned about your expenses. Also, your accountant might be a good resource as well. Now, the taxpaying entity requirement is extremely important. Basically states that the same taxpayer that owned, seasoned, and reported that asset on its return should be the one to sell and to buy. So if I owned a property and it was under my social security number, it's reported on my Schedule E, I should be the one to purchase a replacement property. If I call someone, a qualified intermediary, and say that I'm selling in my name, but I want to buy in a partnership that I have with my sister, that is not going to qualify because it's not the same tax-paying entity that's purchasing the replacement property. There's really no way to even report the exchange correctly on your tax return if you've got two separate taxpayers. Now, there are some exceptions where an entity like a fully revocable grantor trust or a single member LLC that's also disregarded for tax purposes means that you're one and the same with it. So it really uses your social security number. It doesn't file a tax return. So in that scenario, you could sell in your name and buy in your trust. You could sell in your name and buy in your single member LLC and vice versa. So those would be some exceptions, but otherwise the same taxpayer that is selling must be the same taxpayer that's buying. Oftentimes people will say it's got to be the same name, and that's not necessarily true. You could be selling in a single member LLC. Let's say it's LSpeidel LLC, and I can decide to purchase in my name. It's as long as that LLC is disregarded for tax purposes, we're considered one and the same. So that is definitely a question that we ask clients when there's entities. We want to know if the entity is regarded or disregarded for tax purposes. Regarded would mean that it's a separate tax filer, a separate taxpayer from you. Now, total exchange period. This is what gives everyone a little bit of heartburn. So this is what changed, I believe, in the 1984 2024, if I'm not mistaken. The time period to do an exchange, you certainly don't have 5 years like TJ Starker had. You have a total of 180 calendar days. So the first step is, of course, as I recommended before, contact your accountant, your CPA, determine what your tax liability is. Then once you are interested in an exchange, you can reach out to me. We can discuss your transaction. There's no cost to that. I want to make sure that you're aware of all of the requirements. And then once your property is under contract, that's a great time to get the exchange account set up. We'd have you complete some paperwork, provide us with some documentation like an ID, possibly entity documents. We reach out to your closing agent. We prepare the exchange documents for the sale. And then when the closing takes place, the next day is day 1. And you have 45 calendar days to identify possible replacements. We give you a form to use to formally identify. And then you have another 135 calendar days to close. So a total of 180 from beginning to end. Keep in mind, these are calendar days, so we're counting weekends and holidays. If you needed us, you could call our 24/7 line. So let's say your 45th day ends on a holiday or a weekend, and you need to make sure that the form, the identification form, is completed correctly. You can call our after hours number, and there's 7 or 8 of us whose phones all ring at the same time. So we are available 24/7 if needed. Keep in mind, it's not 45 days plus 180. It's not 90 days to identify. These are a lot of time frames that we hear on this side of things. It's a total of 180 calendar days, 45 to formally identify, and then another 135 to close. It begins at the close of the sale, and there are no personal extensions. We have seen extensions given for areas that have seen a natural disaster occur, and then the IRS issues extensions, but we've never seen them on a personal extension basis. Keep in mind that if you are selling towards the end of the year, you want to make sure that you purchase your replacement property before you file your tax return. So if your sale was in 25 and come February 1st, you file your return, but you haven't yet purchased your replacement and you plan to, you've just kind of disqualified your exchange. You have not filed your 8824 form, which shows that you sold and you purchased. You've just really declared a taxable sale. So if you're one of those people who file your returns the moment the IRS opens up the ability to do so, you may want to issue an extension or request an extension or wait until you've made your purchase before you file your return. So it's usually when it closes after October 17th, and that period you are going to go past April 15th if you use your full 180 calendar days. Now, identification rules. We talked about the 45 days to identify. We do give you a form that you would use to formally identify. On the form, you've got to pick an identification method. There are 3 methods. When I go over these 3, please keep in mind that there's no ands, it's or. So you're either picking the 3 property rule or the 200% of gross sales price rule or the 95% exception. So the 3 property rule, which is our most common identification method, allows you to list 3 potential replacement properties. It may not mean that you're buying all 3. You may only want to buy 1, or maybe you do want to buy all 3. That's totally up to you. If you wanted to identify more than 3, you could, but you'd be restricted in other ways. The second identification method is called the 200% of gross sales price. Let's say you sell for $1 million. You could identify $2 million worth of real property. So in this scenario, you are listing addresses and also fair market values, what you would pay for the property. And we would add up all of those values and make sure it doesn't exceed 200% of what you sold. And the 95% exception is the least commonly used, but it allows you to identify as many properties as you want. You do need to give estimated fair market values, and you've got to close on 95% of the value that you listed on the form. So this usually works the best if you are buying everything within your 45 days, or maybe you're buying a portfolio and you're buying everything within that portfolio. So there are multiple ways to identify. We can certainly talk through them depending on what your goals are. Just keep in mind that whatever you do decide to use for the identification, you do need to be as clear as possible. So if you wanted to buy a condo, you couldn't just list the condominium complex, because that's telling the IRS you might be buying all of it. You do want to give a unit number, you want to give a legal description, parcel number, something really specific. Now, what I just explained was the forward 1031 exchange. With a forward 1031 exchange, it could be a simultaneous exchange. We also call that a concurrent exchange. It's really all happens on the same day. You sell and buy on the same day. We do execute those. You've got to get the timing right, of course. And then most of our exchanges are delayed exchanges. And that's where you sell first, you buy second. That's where you use 180 calendar days or less to make your purchase. There also are, there's a structure called reverse 1031 exchanges. And this is definitely a more complex structure. It always sounds really great, except when you get down to the details of it. It is much more complex. It's much more costly. With a reverse 1031, you are buying first and selling second. The key, though, is that you can't own both properties at the same time. So as a qualified intermediary, not all qualified intermediaries can act as an exchange accommodation title holder, but we can, and that allows us to do some of these more complex transactions. So we create an exchange accommodation title holder agreement, which is basically an LLC. We never reuse LLCs. You definitely don't want to have a qualified intermediary be doing that. It puts you at risk. It puts the qualified intermediary at risk. So a brand new LLC, and it will park title to one of your properties. Usually we park title to the replacement property, and then you'd have 180 days to sell your current property. So you are going to contact us before you buy, and then we'll talk through the different scenarios. Lenders do not love these transactions. So if you have cash to make the purchase, that will make it much easier. There are some scenarios where we would park title to your relinquished property as well. But there's a lot more that goes into the reverse. Just know that it's an option. There's also a build to suit, also called improvement or construction 1031 exchange. And that's where you want to purchase a property, but you're not using all of your proceeds for that purchase. You've got extra proceeds that you want to use to make capital improvements. So in that scenario, you're not able to own that property yet until you're done using your exchange funds. So let's say, for example, you are buying a property for $400,000 and you want to make $100,000 of improvements. We would have the same parking arrangement as the reverse. It's called an exchange accommodation title holder agreement. It would step in for the shoes of the buyer. It would purchase the replacement property on your behalf, park title to it. You're named construction manager. As invoices come in, you're signing off on them. We're paying that contractor. And during those 45 days, you're not only identifying what you want to purchase, but you should also list the capital improvements and the costs associated with that improvement exchange. And then you'd have a total of 180 calendar days to make as many improvements as possible. If you had $10,000 left in your account and you needed $10,000 of flooring, you couldn't just have the contractor buy the flooring, throw it down on the lot, and consider it part of the real estate. It's still personal property until it's attached. So we would recommend at the tail end of the time period, really take pictures and videos of what's been completed. Now keep in mind your value, if you get an appraisal, might come in much higher than what you need for the exchange, but we're not looking at that. We want to make sure that you have reinvested all of your cash, you've reinvested your debt amount, and all of that has been built and attached to the real property in order for that full amount to qualify. As you can tell, it's a much more complex structure. It is going to be much more expensive than a typical forward exchange. And then there's also foreign property 1031 exchanges. There are not many companies that do foreign property exchanges. We actually get quite a bit of referrals from other qualified intermediaries. Depends on where you're selling and where you're buying, but if you're selling a foreign property and you have US tax liability, you could buy another foreign property. and defer the US tax liability. There's no other country that I know of that has something like a Section 1031, but just keep in mind that it's the same requirements that we just discussed. It's just that like-kind property requirement is different. Foreign property is like-kind to other foreign property. Now, the next slide talks about strategic tax planning. In some scenarios, this might make sense. In other scenarios, it may not, but it's a way to explain that the 1031 exchange can be used in many different ways. What we have seen is people buy an investment property. Let's say, I was going to use Florida as an example, but I'm seeing a lot of people leave Florida for numerous reasons, but insurance is definitely a big hot topic there. But let's say you buy an investment property in the Carolinas, and it's been an investment property for a number of years. It was a replacement in a 1031 exchange. And now you decide, you know what, I want to make that my primary residence. I'm retiring. You sell your primary residence. You take part in Section 121. You get that exclusion on your primary residence. You get those renters to move out, and you now live there. If you live there until you pass away, there's no tax liability. But if you live there for a number of years and then decide, you know what, we don't want to live here anymore, now there's going to be a proration. It's based on the number of years that that property was a rental versus a primary. Let's say you rented it for 5 years and you lived in it for 5 years. So half the time it was investment, half the time it was a primary. As long as you have owned that property for at least 5 years, you've lived in it for at least 24 out of 60 months, and you satisfied the exchange, you rented it for 5 years, you should be able to get a portion of the exclusion. Let's say you're a married couple and it's $500,000. Half of it would go towards the investment side, the other half would go towards the primary side. So it's a way to lessen your tax liability. It can be great for someone who eventually does want to retire into that second home or vacation home that they have. Now, I would recommend you talking to your accountant when you get ready to sell, because you really want to know what tax liability you might have when you sell. You might be surprised to find that it could be pretty significant, because what we're talking about when we talk about this exclusion is gain, pure gain. Depreciation recapture will still be due when you sell the property. So the only way to get rid of depreciation is either to pay it or to pass away. So that is the bad news when it comes to something like this. So again, if it's something you're going to live in until you pass away, this can be a great kind of, tax strategy. The other option could be if you live in a primary residence and you've seen significant gain. We see this a lot on the coasts. We had someone, for example, that bought a primary residence in California over 30 years ago for like $300,000. They went to go sell. The appraisal was around $8 million. And so they moved out. They got renters in there for 2 years. And then they sold it within that 5th year. So they still qualified for that primary residence exclusion of $500,000, and the rest went towards investment property. So this would make sense if your primary residence has significant gain, much greater than Section 121 allows. So just keep that in mind. That is definitely a tax planning scenario. Now, another thing that I want to discuss is just qualified intermediary. We are not regulated, and the good companies have gone to the Department of Treasury and asked to become regulated, but they have said that the cost exceeds the risk to the client. So they really don't want to pay people to regulate companies like ourselves. So you really want to make sure that whatever company you choose to go with, of course, we hope you come to Exeter, but that they've been around for a number of years. They have good reviews. They are maybe referred by a friend or an agent of yours. You want to make sure that they have extensive experience and expertise. They are very knowledgeable about Section 1031. You also want to make sure that they have proper insurance coverage. We have 10 million errors and omissions insurance, which I believe is extremely important because humans make mistakes. We also have 10 million fidelity bond insurance. That's someone running away with the funds. That would be almost impossible to occur here. There are 4 separate Exeter employees that need to initiate a wire and send the wire out. So there are extra protections in place to protect our clients. We also carry 10 million of cyber fraud and wire fraud protection. That industry is definitely getting smarter and smarter. So there's a number of steps that we take to protect our clients. And then we can also provide insurance binders in case you want to call to verify insurance. There was a very large title company over 15 years ago now called Land America. They were the 2nd or 3rd largest title company in the US. And in 2008, they took client funds and they bought auction rate securities, which are typically very secure, except this was 2008, and the market crashed and they lost all of their client funds. They started to move funds throughout their organization until eventually they filed for bankruptcy. When they filed for bankruptcy, the bankruptcy judge ruled that since the funds were not held in a qualified trust or qualified escrow account, they were not legally protected. So it took about 10 years for those clients to get their funds back. I think they were eventually purchased by Chicago Title, if I'm not mistaken, or Fidelity. So that really set us on a trajectory to become a trust company. We have a trust company located in Cheyenne, Wyoming. Exeter Trust Company does provide other lines of service for our investors: self-directed IRAs, self-directed 401ks, land trusts, specialty escrow holding accounts, so other things that investors may use. But it also sets up a qualified trust account for every single client. So every client has their own qualified trust account to hold their funds. That means that their funds are not commingled with any client or corporate funds. It's also a dual signature account. That means that we are unable to move any funds without the client's signature. And when we are audited by the Wyoming Division of Banking, those are things that they're looking at. So we have government oversight, again, just extra protections. And then because we are a trust company, we have an omnibus account that spreads your funds amongst 11 different banks. So you receive $250,000 of FDIC insurance from each one of those banks. And if needed, we are part of the Insured Cash Sweep program, which can give up to $150 million of FDIC insurance. So if you'd like to discuss our safeguards, we've got a great article that I can share with you as well that really discusses the benefits of the qualified trust account, the benefits of being regulated, and that is definitely important. Unfortunately, a lot of people will call and just ask us what our fee is. There's a lot more that goes into it than just the fee. Here's just a little recap. Again, I just want to remind you, if you do have any questions, top right-hand corner under the question box, you can type it in there. But I'll just go through a synopsis of what we discussed. Again, Exeter is a qualified intermediary, also called a QI or a 1031 exchange accommodator. We can act as exchange accommodation title holder or an EAT. So we can do some of those more complex transactions. We do forward, reverse, improvement, foreign property exchanges. We can do them nationwide. There's not a state that we haven't worked in. We also are available 24/7. So if something comes up on the weekend or you've got questions, you need a verification of funds letter, or you need to review an identification form, you certainly can give us a call. Our website is www.exeterco.com. And then the last page is going to have a bunch of contact information. So my direct line is 630-828-5200. My cell phone, you can certainly call as well or text it. My direct line does ring to my cell phone as well. So if I miss your call, I'll call you back as soon as possible. Corporate headquarters, this is our 24/7 line, 619-239-30991. And then my email address is there. That is a capital LSpeidel at exeterco.com. And then we've got our website. And then I also have a website that has some information as well, www.trustexeter.com/Lauren. Both of these QR codes are great. The 1031 contact information, if you use your phone to hover over that and you click on that website that shows up, you can save me as a contact. And then on the right side, we've got this guidebook again. So if you didn't get a chance to scan it in the first slide, this is our most requested marking piece. We get a lot of great feedback on this guidebook. It also has a table of contents on the second page. So in case you want some light reading before bed, this can certainly lull you to sleep. But with that being said, I'm just going to check to see if there are any questions. And of course, if you want to reach out to me individually, you certainly can as well. And that will wrap up the presentation. I don't see any questions in the chat box. I'll give it just a couple minutes to see if anyone adds anything. If you want me to call you after this, you could definitely send privately to me a question and I can give you a call. But yeah, I'm not seeing any questions pop up. So with that, I think all of you know how to contact me. If you need anything, you want hard copies of this, definitely don't hesitate to reach out. We also have a shortened version. I don't actually have it on the PowerPoint, but this is a quick reference guide. This piece is great because it just talks about the main requirements of the exchange without getting too detailed, because it certainly can be like drinking from a fire hose at times. But if you have something you'd like to discuss specifically, please don't hesitate to reach out. And I look forward to working with all of you. Thank you so much. You have a great day.